Okay, it's preparing the live stream now. I'll let you know when it says that we are live. Okay, looks like we're live.
Right, all right.
Um,
Excellent. Going to get into the thick of things. Cam Blank Sorrell at the Bullish Institute of Financial Literacy, delivering to you Stock Market 503, which is trading, the final of three lessons of training, learn how to trade stock options. Need to just get that hosting so I can share
yep,
my screen, please.
you are the host.
All righty. Excellent. So you should be able to see my screen now. And I'm going to actually stop my video for a moment just because I don't want to mess up the bandwidth. Um, but here we are, stock market 501, 502, and today is 503. I'm going to get in these options, third part of the three-part series, courtesy of the great folks over at the Pontiac Public Library. Quick disclaimer before we get into things. We're not providing stock market trading advice. All right. This is, I'm not a stockbroker. I'm not a financial planner nor an advisor. So I'm not here to physically touch or manage your money. We're not responsible for your money. You are, right? Because it's yours. We're here for educational and informational purposes only. So just wanted to get that out the way real quick. Normally I'll do a recap of the previous lesson, but since it's been a little bit of time, just kind of go through some of these slides real quick. I'm going to move past all the agenda stuff, but just a couple things to recap with before we get into the thick of things. And that is, we want to know the actual DNA of a stock option, right? And how it's made up, right? This is the DNA. These are the mechanics of it, right? Just to recap, we know that stock options are derivatives. That's an asset class in which their value comes from some other place. Where that value comes from is an underlying stock or ETF, which would be called the underlying asset. All right. Essentially, stock options are contracts. They're an agreement between a buyer and a seller. And those agreements all have an expiration date, what is the most unique feature of options. All options expire. They all expire. Stocks don't. The only time a stock expires per se is if it goes bankrupt, right? If they lose all of their money. But if they don't, the company goes on, right? Henry Ford, who founded Ford Motor Company, he's been gone for decades, right? But Ford Motor Company still lives on to this day, as does their stock. Walt Disney has been gone for decades, but the Walt Disney Company is still here and it has not expired because they're not bankrupt. All stock options expire though. Your Disney stock options will expire. Your Apple stock options may expire. Apple still lives on even though Steve Jobs is not here with us today. Stocks do not expire. Options, all of them do. And options expire on Fridays. Right, on Fridays. If they're a weekly option, they expire every Friday. If it's a monthly option, they expire on what's called Options Friday, which is the third Friday of each month. That's when options expire. And if in this contract, not only do you have an expiration date, you have a strike price. That's the agreed upon price between the buyer and the seller in which the option will transact. All contracts have an expiration date. All contracts have an agreed upon price, which is the strike price. The premium is what a buyer pays for an option. You buy an option, you pay a premium. People who sell or write options collect the premium. Exercise. If you buy an option, you are paying for a right, and you have the right to either buy or sell an underlying asset, all right, or not, right? That's your option. So if you exercise, that means you took action on your right, or you can let it expire worthless. You can let your contract expire worthless. If you sell options, you can be assigned on them, meaning you have to take the other side of the transaction, whether that was to either pay cash to buy someone out if it was a put, or if you have to sell your stocks in order to satisfy a call. You can get assigned. The The way options work, they have buyers and sellers, long or short positions, and buyers have rights, sellers have obligations. Sellers have no rights. And there's two directions, right? You can either deal with calls or you can deal with puts. Calls allow you to call stock away from somebody else, and puts allow you to put stock onto someone else. All right. So calls are for people who want to accumulate more shares of stock. Puts are for people who want to protect their stock with cash. Primary reason people trade options because of leverage. We all know you put out a little bit of money and you can get a lot of bit of leverage, similar to that of real estate. And then the risk management piece, because the only thing you can stand to lose is what you put in the game. You cannot lose $1 more than you put up when trading options. All right. You can lose the premium. You can lose the whole premium. You don't have to, but you could. Right. But in the case of a stock, a company could go bankrupt and you could lose everything. Not going to watch these videos. There are only 4 trades, right? You can either buy a call or you can sell a call. You could buy a put or you can sell a put. And people make money and profit whether the stock market, the stock goes up, goes down, or ranges sideways, because there are only 4 trades and you can put together the trades in any combination to meet your strategy. Whether you have something short term, you're expecting a price movement up or down within the next couple days, couple weeks, and options can go up to 2 years. All right. Options that are that go from 6 months to 2 years are called leaps. Those are long-term options, leaps. So you can actually have a contract that's good for up to 2 years, but they don't last longer than that. So when you put it all together, just to recap from our first lesson, stock options process, a buyer and a seller agree to create a contract. That contract is known as a stock option. It has a set price. That set price is known as a strike price. It has an expiration date, which is going to be on a Friday. If it's a monthly, it's on the 3rd Friday. Otherwise, it's any Friday. And you have 2 types of options, calls or puts. Calls, the way you make money with calls is if the stock price or the ETF price or the index price, whatever that underlying asset is that the call is attached to, if it goes up, then the value of your call contract goes up. If the underlying price goes down, then the value of your call option contract goes down as well. And the reverse is true for the put side. All right, the put side. In the case of the put side, if the underlying asset price goes down, the put is more valuable. And if the underlying price goes up, then the put is less valuable. So pretty much it's the same. It's like driving on a separate side of a street, but it's the same street. You can take Telegraph North or you can take Telegraph South. One to get you to Detroit, one to get you to Pontiac. But on either side of the street is 50 miles an hour. It's the same speed limit, same speed trap, same everything. It's 2 separate sides of the street, just different directions. If you're in Detroit, you can't go south to get the Pontiac. You have to go north. You need to get a call option. And if you're in Pontiac and you want to get to Detroit, you can't go north from Pontiac to get Detroit. You got to go south. It's a put option. That's all it is. Opposite side of the street. Option outcomes. Options outcomes. It's very important to know that basically 70% of options are closed out before expiration. Most people don't wait till one of those Fridays to cash out. All right. You run into a situation where you can be in a race against time if you wait till the last week of a contract or 2 days to go or the day of. So 70% of successful traders in options either buy or sell to close out their position early. 20% of the contracts expire worthless. And basically 10% of the time people actually exercise. Right, roughly 10%. On the graph here, 11.6 on this pie graph, but just using round numbers, roughly 10% of the time people actually fulfill the exercise part of the option. So really it's a game of hot potato is how people make the money, right? They buy something for low and they flip it to somebody else in the options market for more, for higher. Buy low, sell high, still applies in this arena as well. Just not dealing with stocks, is dealing with stock options. So we went over how to read a quote. We talked about moneyness. We looked up and down the options chain, right? This was an example we did looking at AT&T calls for July 16th, 2021. And in case if you're buying a call, the in the money strikes are the strike prices that are below the current market price. That's what in the money or ITM means. Those are the strike prices that are give you more probability of profitability. They're more than likely to expire worth something in the money. ATM means at the money. All at the money is the strike price that's closest to the stock price, right, or market price today. In this example, we're looking at AT&T being 28.50. So the at the money strikes would be either the 28 or the 29. Those are at the money strikes. The strikes closest to the stock price. Now, if AT&T stock price was say $28.10, then the at the money strike would be 28. If it was $28.90, then the at the money strike would be 29, because whatever singular strike is closest to. But in the case that we called it 28.50, either strike could be considered at the money. Out the money, OTM. Those are the strikes that require AT&T to make a move, right? The stock has to move to get towards those numbers in order for you to be profitable. So out the money, OTM, people buy the out the money strikes because they have a cheaper premium price. All right, if you look at the $24 strike up the chain in the blue, the $24 strike costs $4.85 per contract, which would be $485, right? That's in the money though, right? And that's more likely to be successful for you. However, if you don't want to spend $4.85 a contract, you don't like the $24 strike, you can go out the money and buy the $34 strike. Look at that, only 28 cents, right? So you're only paying $28 a contract. However, the likelihood of AT&T being $34 a share on or before July 16th is not as likely as it being $28.85, right? Because the 24 strike plus the $4.85 premium you paid is $28.85. So that would be your break even. And it's more likely for AT&T to be $28.85 by July 16th than it is for it to be $34. Even though the 34 was cheaper, you could have bought way more contracts. If the stock doesn't move, you won't win. In order for AT&T to move from 28.5 to 34, you're asking for some distance. That's over a 10% move. All right. That's over a 10% move. And so AT&T historically isn't a company that moves like that. Not historically. All right. We looked at the put side. And if you look at the put side, it's the same role like we talked about telegraph. It's just northbound versus southbound, right? Now look what's different. We looked at the 24. The $24 strike on a put is only worth 53 cents a share, or $53 a contract. And the $34 put is worth $630 a contract. So it's the value of the contract, the premiums are completely opposite from calls versus puts. So pay attention to that, and you want to have an overstanding of the psychology of why you would pick either side of the trade. Why would you be doing calls, or why would you be doing puts, right? Because you have a sentiment, an outlook, right? If you're bullish, you typically deal with calls. If you're bearish, you typically deal with puts. Talked about liquidity. Again, not trying to show any old videos. Just want to keep moving through the slides on the recap. How to value an option chain. We value premium. The premium price has two components: intrinsic value and extrinsic value. Intrinsic value and extrinsic value. The intrinsic value is the difference between the stock price and the strike price. And whatever's left over is the extrinsic value. So let me go back to us in these AT&T calls. All right. If AT&T is 28.50 right now, right? 28.50. And we went and bought the 23 strike, right? We bought the 23 strike. That's a $5. It's $5.50 below the market price of 28.50. That's what the 23 is. 550 below. So that 550 is $5.50 ITM in the money. That contract is $5.50 in the money, right? Because I just took the difference between 28.50, the stock price today, the market price, and subtracted the $23 strike price on this contract. However, when you look to the right of it, you see that it costs $6 per share for this contract. This is a $600 contract. Well, it costs $6 for the premium, but it's only $5.50 in the money. So I would do is I take the $6, subtract out my $5.50, and that leaves me a 50 cents difference. What is that extra 50 cents? That extra 50 cents is the extrinsic value. That's the extrinsic value, right? And you can look up and down the options chain and you'll always see that, right? You'll always see that. And when you buy in the money, you are buying more probability that you will be profitable. When you are at the money, it's pretty much a 50-50 gamble. When you go out the money, it's pretty much all a gamble. Whether you're doing calls or puts, when you go out the money, the further out the money, the more risky it is. As it relates to the call side of things, I like to buy my options in the money, and I like to sell my options out of the money. All right, typical rule of thumb: buy them in the money, sell them out of the money. All right, the extrinsic value is also known as time value. Time value. Because all contracts, all options expire, right? They all expire. There's always going to be some value in the time left on the contract. An option contract that expires in 2 years is more valuable from a time aspect than the one that expires in 2 months or 2 weeks or 2 days, because you have to pay for that time, and that time remaining on the contract is priced into the premium. All right. As you may have recalled from our last session, that time value is comprised of what's known as the Greeks. And we're going to get into that quickly with some more to review.
When traders talk about.
So that was our first review of part 1. Part 2, we got into the Greeks.
Options.
All right. We looked into the options chain up and down Yahoo Finance, which I just showed you a glimpse of on the previous 2 slides from the call and the put side on AT&T. Right. And we spoke about the Greeks. Right. The Greeks deal with price movements, time decay, volatility, and interest rates. All right. In no particular order, delta represents how your premium will be affected for the first $1 move up or down in the stock price, in the underlying. And it could be a stock or ETF. It don't have to be a stock. But if for every $1, for the very first dollar up or down that your stock moves or ETF moves, what impact does that have on the premium? That's what delta tells you, right? Delta is one of the biggest components of trying to calculate what your profitability will be on trading options. Delta. All right. Gamma works with delta. Going out of order from the screenshot, but a better way to explain it. Gamma works with delta. Only on the first $1 move up or down the underlying is where delta tells you what's going to happen in the options premium. However, for the second and beyond dollar move up or down is delta plus gamma. Right? They work together. And that represents price movement. Price movement is a huge part of options trading. Theta represents time decay. If you buy an options contract, you are in a race against time because all contracts expire. You are racing against time. If you sell options contracts, then time works on your side. You have Vega. Even though V is not a Greek letter, Vega is not a Greek word or letter. Wall Street has its own rules, so it made its own Greek letter. But V represents volatility, right? Volatility, because we know stocks go up, stocks go down, it's choppy waters, and it's a risk factor, right? Vega represents that risk factor in the stock options universe, all right? And then last but not least is Rho. And Rho is considering interest rates, how interest rates impact the pricing of a stock or ETF, their premium on the options. Interest rates, because certain stocks, certain industries are affected by interest rates more than others, like banks, possibly insurance companies, right? Pretty much anything dealing with lending money, right? That's interest rate related. Anything dealing with some kind of banking, right? Those type of companies may be impacted by interest rates. Others are not. So it's Delta, Gamma, Theta, Vega in a row. All right. We taught you how to look at the Greeks. We looked under the hood at that. We had showed you through the Robinhood app. We had discussed, and I'll show you real quick how to look at it. One quick time. Let me see. I got to switch to hosting. One moment to do that. All right, so let's go ahead and pull up the Robinhood real quick, just so you guys can see the Greeks on the refresher. So we're going to look at the Greeks, going to Robinhood. So we're going to go down and look at a company. Let me see. DoorDash. Somebody was telling about DoorDash, ticker symbol DASH dash. Go and look to trade options on DoorDash. And so the first thing it's going to ask you to do is figure out what is your expiration cycle. So let's say we want to see what's going on with DoorDash by end of August. We're going to go August 20th. We want to buy a call. Wow, these are some kind of pricey premiums here, but it's 124. Call it, well, 24.98. So call it DoorDash is 125. First thing I want to do is figure out my outlook, right? How high do I think it's going to go, right? And then I'm looking at these premiums. Wow, you're really paying for these premiums, but but they cost more because all this time, right? It's May. This is an end of August contract. If I pull back and say, well, it's May, let's look at what it costs for the end of May. See, half the price. But that means we're expecting DoorDash to make a move quicker. So if we want to look at, let's look at that 125 call. It's $950 on the May 28th. You go out to June 11th, the 125 went up to $1,100, right? On May 28th, it was $950. June 11th, it's $1,100. June 25th, the 125 is $1,250. You want to go all the way up to November, it's $2,240 for one contract, right? See, if I hit review, it's saying, well, first I don't have enough to buy this, but I would be buying one contract, right, of options because the leverage represents 100 shares of the underlying stock. And in this case, I would be saying that I'm willing to pay $2,240 today for the right to buy 100 shares of DoorDash on or before Friday, November 19th at $125 a share. That's what an option contract is. If I hit this right here, the green part, right, the bid and the ask, if I click that, it takes me to what's under the hood, and I can see the stats of this particular contract. I see that there really isn't any open interest in it. Remember, the rule of thumb, you want to have at least 40 times as many contracts as you plan to buy or sell in the open interest, so that you know that there's a market for what you're trying to do. Right now, no one's looking at looks like no one's really checking for that strike price at that expiration cycle. But if you look at the Greeks tell you that the delta is basically 59 cents. So if DoorDash goes up $1 for that very first dollar, you'd make $58 on your options premium, because 58 cents, right, times 100, because it's 100 shares in each contract, would be $58, right? For the second dollar move up, it would be the delta plus the gamma. But you see, this one don't even have a lot of gamma. So it basically moving the same thing with delta. If you look at theta, the contract is saying that you're basically losing a nickel every day that passes, right? Because it's got a negative 5.5 cents. So you're losing a little bit more than a nickel on the contract premium with every day that passes. And Vega represents volatility, right? As you can see, that volatility is kind of high, as is the row. Interest rates are, and you look at the applied volatility up there, 62%. I mean, that's kind of choppy waters. Doesn't look like it has a high chance of profitability based on, what Robinhood thinks. But this is just making sure you know where to find the Greeks, right? Where to find the Greeks. That's DoorDash, right? Go find a stock, any stock. Here's Square. Look at Square. Trade options. Look at May 28th at the money. So Square costs double DoorDash, but if you look at their at the money strike, it costs about the same. I think DoorDash's was like $9.50. This is $9.75, but you get leverage over a stock that costs $235. June 11th. And then we also looked at September 17th. Let's see. So let's go. So we'll look at the Greeks. See, this one has more open interest, not a ton, but enough to cover one contract, maybe two. A little bit of volume, not as much volatility, higher chance of profit, lower deltas, higher gamma, lower vega, pretty high theta. Why is the theta so high? Because this is a contract that expires June 4th. So this has less than a month to go. Sorry, May 8th. So this is June 4th. So yes, thetas are higher the closer you get to expiration. It's called theta burn or time decay, right? It kicks in on you. So I just want to make sure you know how to look at the Greeks, know how to find them. It's easier to look at them on your trading platform than Yahoo Finance. Yahoo Finance will show you Yahoo Finance will show you the options chain, but it doesn't really do a great job of showing you the actual Greeks. So we're going to get switched back over to my laptop. Okay. All right. Hope this has been valuable so far for all of you following along. So we also covered profit and loss diagrams. Profit and loss diagrams, the P&L, right? The top and bottom is the profit and loss, right? You can represent that in dollars or percentage of gains. And then left to right is simply the price movement of the stock. We looked at the long call, which we just discussed, is buying the contract because you're optimistic that it's going to be worth more sometime out in the future. You buy a long call. A protective put is for people who own shares. Let's say you already own 100 shares of stock and you're nervous that the price may fall out. Well, you may buy a protective put to protect your position. You want the stock, but you don't want it to drop from $20 a share down to $5. You're nervous about the volatility or the future or whatever. So you can buy a protective put to cover you like an insurance policy over a specific amount of time. And you know that if something hits the fan and your $20 stock drops to say $5, you won't be there left holding the bag because you had a protective put, and you could have had that protective put locked in for $18 a share. That if it starts tanking, somebody else will cash you out 18 a share, no questions asked, because you paid them the premium to do so. No different, we pay premiums on car insurance, right? If you total your car, whatever, the insurance company comes with the brand new car to fix or the repairs to make it right. But you only paid a very nominal premium on a monthly basis to take advantage of that. So it's very similar to that. Buy right. A buy right is the covered call strategy. That's one of the more popular strategies I like to discuss. One of my income strategies I use to be consistent. And so I think it's something worth considering for everyone's portfolio is when you actually buy 100 shares of an underlying asset, whether it's a stock or ETF, and then you turn around and you flip it. You make a premium on it up front, and you are willing to flip it, right? It's not a guaranteed flip, it's you're willing to. So what it means is, like, let's say I had a $25 stock, had 100 shares of it, so that's a $2,500 tied into it, and I do a covered call. What my mission to do is to collect the premium up front, and it basically works like layaway. Someone's paying me a fee up front for the right to buy 100 shares of my stock off of me for a higher price on or before a specific date, right? That's all it is. It's like layaway. But what if somebody don't actually want to buy the clothes or buy the furniture or whatever they put on layaway? Then you keep the layaway fee. That's what the premium was. And then you just wash, rinse, and repeat. So that's really what it is. It's like collecting layaway fees. And you want to keep putting the price out just far enough out of reach so you don't actually get assigned on the contract. Because if you get assigned, then you got to sell the shares because these are contracts. And you have to perform on your contract. You have to fulfill your obligations. Sellers of contracts cannot back out. Once you collect that premium, you are on the hook for whatever the other side of that is if the buyer exercises. However, we know that only 10% of the time, 11.5% to be more accurate, do people actually exercise. That's why you want to sell your options out of the money so that it's less likely that you'll get assigned, is less likely that they'll exercise, and is more likely that you'll lock in a profit. You want to be able to look at profit and loss diagrams, and you make money a lot of different ways, depending on the diagram.
The profit and loss.
So that covered part two. Part two review. No videos. Now we get to get deeper into the nitty gritty. Part three. Part three. Final part of the stock options trilogy for beginners, newbie, and savvy investors. So let's get into the thick of things.
Options involve risk and are not suitable for all investors. Options investors may lose the entire amount of their investment in a relatively short period of time.
Hello, today we're going to talk about common option trading mistakes that beginning option traders make. First of all, before we get too far, let's talk a little bit about what an option is. An option in general is a contract, and it gives the owner the right to buy or sell an asset at a fixed price for a specific period of time. It then obligates the seller of the contract to take the opposite side if and when the right embedded in the option contract is exercised by the owner. Bottom line is, the buyers of contracts, they pay cash, and for that cash, they get a right. The seller of the contract receives the cash, and for receiving that cash, they take on an obligation. All right. The first most common mistake that we're going to look at is buying out of the money option contracts as their first trade. Out of the money option contracts are very compelling to beginning option traders because they're cheap, but they're cheap for a reason. So we have to talk a little bit about that reason to understand why we are making that mistake. Now, before we get too far though, let's define in, at, and out of the money option contracts. On our graphic, we actually see the y-axis is the stock price. And our stock price here is going from 50 all the way up to 70. The x-axis is the strike price of our option contract. And today we're talking about a call option that allows you to call stock away. Our strike price in this instance is a 60 strike call option. So if the stock is at 60 and the strike is 60, that's considered an at the money option contract. It's fairly intuitive. As the stock price starts going up, guess what happens to the 60 strike call? It becomes in the money. And if the stock starts going down, guess what happens to the call? It becomes out of the money. Now let's look at an actual example. We have XYZ, which is a fake stock. It's trading at $60 a share. Our forecast is that we are bullish on the marketplace, so we're going to buy an option contract. We think the stock market is going to go up. We see our XYZ 30-day 65 strike call option is trading for $1. Now that's a very inexpensive relative to buying the stock. If it's trading for $1, that means that our total cost is $100 plus commission to buy this option contract. Now our max risk will be that $1 if we only buy one option contract, or $100. Our max profit, it's unlimited on the upside. If the stock went to infinity, we would get infinity, highly unlikely, but if it did, we'd have that type of upside. Our break even now has changed quite a bit though. Our break even is our strike price plus the premium that we paid for the option contract, or $66 here in our example. Now let's look at a graphic of this actual trade and compare the profit and loss graph of the option contract to what the stock profit and loss graph is. We see here on the blue line, we see the stock is trading at 60. So where we cross the x-axis on our graph is going to be our break-even point. But with the option contract, we're actually going to the strike price plus what we paid for it. So our break-even is $66 here. And so here's the difference about just buying the stock outright relative to buying that option contract. If you buy that option contract, you're saying you expect the stock to move, in this instance, 10% before the expiration of that option contract. And we're only talking about 30 days here. So yes, that option contract was cheap, but realize if the stock only goes half the distance, it's at $60 and it goes up to 63 and it doesn't make it by that expiration date, it's possible to be correct on your forecast and actually lose your entire investment on the option contract. So how can you trade smarter? Let's not buy that contract. Let's look at selling the option contract. So the next example that we're going to look at here is actually selling a covered call on a stock that we own. So let's pretend that we own 100 shares of that stock. In other words, instead of just buying the call option at a 65 strike, we own 100 shares of the stock at 60. We then go out and look at this option contract that's trading with a 65 strike for $1, and we decide we're going to sell that, receive the cash, and take on an obligation to sell the stock if it goes higher. So our example, we're long 100 shares. We're bullish on the stock. We think the stock could go up to 65. We wouldn't mind selling it if it made it all the way there. XYZ 30-day 65 strike call is trading for $1. We sell that. Our max risk is still substantial in that we own the stock. So we still have a lot of downside risk of owning the stock. But the option contract actually increases our profitability if the stock goes up to 65. So our max profit is going to be 6. We have an opportunity loss if the market continues on up. Our break even here, we've actually lowered it from where the stock was at. It's 60 minus the premium received, or 59. And if we look at the graphic here, we have the actual stock price on the x-axis. We have the profit and loss on the y-axis. And we noticed that we lowered our break even. Instead of making the break even higher by buying the call outright, we've now lowered the break even down to 59, which is the price of the stock minus the premium received. So when you're thinking about buying option contracts, you got to realize that they are priced much differently than buying stocks. So, as opposed to learning by buying options, sometimes it's better to learn by selling options. So, the strategy that I suggest for beginning option traders to start with, covered call writing. Well, that's it for today. I look forward to your questions and comments. In the meantime, may all the options you bought finish in the money and all the ones you sold finish out.
Yes, yes. Brian Overby with Ally Invest. He has a great book out called the Options Playbook, Stock Options Playbook. It's like 40 P&L diagrams that break down the whole strategy. You know, how you break even, how you enter, how you exit, the risk and rewards involved in 40 different strategies. All right. So definitely look for that. The Options Playbook by Brian Overby with Ally Invest. These are some of those strategies and what they look like. Now, we did see in part 2, we looked at the cover call, the long call. The cover call is called a buy right, I believe, on the week, this second class in that example, and the protective put. So you see 3 of them right there, but clearly there are much more than 3 of them out there that are available. You can do collards. You see the cash secure put there. Which is a strategy I like to use along with cover calls. Cash secure puts and cover calls are pretty much my bread and butter for how I generate income on a weekly or monthly basis trading stock options. You also see on there, you got the long call, you got the long put, fig leaves, long call spreads, and long put spreads. Spreads are basically a combination of option trading where you would do 2 things at the same time. Usually it's in the same expiration cycle and with the exact same underlying company. So you could do something like, you know, look at the July 16th expiration cycle, and you could buy, you could buy a call and you could buy a put at the exact same time on the exact same strike price. Or you could buy a call and buy a put on the same expiration cycle for the same underlying, but you have different strike prices, right? One could be more out the money and one could be in the money, but they all create different scenarios, right? Because you got to calculate the premiums you pay. You buy in 2 things, right? Some people sell 2 things. So it's just a number of ways you can do it. But this is give you the names of some of these strategies and things you can do research, because I'm not going to go into these 9 diagrams today, but half of them you're already familiar with just from making it through to the 3rd installment of this webinar series. All right. But it's important that you are comfortable, you're familiar with looking at profit and loss diagrams. All right. You want to know what you're in the game for. You need to know how to calculate your profit, how to limit your loss, how to manage your risk, because there's always a downside potentially. You always want to consider the downside in any trading scenario, okay? But I want to keep these things in front of you so that you're not intimidated and that you're comfortable with it, because the more you work with them, you really see how simple it actually can be. The main basis with options is their directional plays. And the cool part about it is underlying assets, whether they're stocks, ETFs, or index funds, can only move one of 3 ways. They're going to move up, they're going to move down, or they're going to pretty much stay flat, go sideways, right? That's it. Up, down, or sideways. And there is a strategy that you can be profitable on no matter what your outlook is. The only thing really that I think that gives options a more of a challenge or spin, a twist, if you will, over trading stocks is the fact that it's the time factor, right? They all expire. So yeah, you might say, I think this is a great company and stock's going to go up one day. Well, you can say that if you own the stock, right? Because one day, someday, possibly in the future could happen. But if you play that in the options land, it's got to move in a direction and hit your target within a specific amount of time. Typically within 2 days to 2 years. So you got to be really right? If you're really right with options, you really make money. And if you're really wrong, you can really lose your entire premium. But the cool part about it is all you can lose is your premium, right? It won't blow up your portfolio because none of us are going to put all of our money into an option because we're just learning, right? So there's nothing wrong with putting your baby toe out there and buying some options, but you don't ever bet the farm, especially on a game that you're just learning how to play.
We're talking option strategies with John Carter. John, I guess in this kind of market, a lot of people, when they're looking to hedge or take advantage, leverage some of the upside and protect against the downside, start thinking about options. So what option strategies should they look at?
Yeah, options can get very complicated very quickly, and I do talk to a lot of people where they just think that options get over their head very quickly, and it doesn't need to be that way. And I think that is just because the very nature of options, you can do like these three-legged quick clipped wing butterflies and different things like that.
Right.
And here's the thing: just because you can do that doesn't mean you should. Okay, and I really think the easiest way to use options is simply look at it as a cheaper way to own the stock. Okay, and that's the most important thing. That's the first one. So Apple at $500 a share is kind of hard. That's kind of like, gosh, buying 1,000 shares, you got to lay out $500,000. Well, you could buy 10 slightly in the money contracts, and that's a whole different ballgame. You can actually then participate in the price movement. So I think that's the first thing you want to look at. You want to do analysis on the underlying stock, all right? And if that analysis is bullish, great. Buy some in the money calls, like Delta 70 or above. If it's bearish, you can do the opposite. And really beyond that, things are actually very simple from that too. Beyond that, the only other thing that I'd like to do is sell premium. Okay, and what that means is you take those options that are out of the money, a couple of strikes out of the money, and you have to sell them. So a lot of times what I'll do is I'll just buy like an in-the-money call for like directional purposes, and if it starts moving towards my target, I can actually start selling some out-of-the-money calls against it, and then those actually start losing premium. So it's almost like it's kind of like a poor man's covered call. But I think just think of it as a cheaper way to own the stock. Okay, that's your first and foremost priority with the options market, and then from there is an opportunity to sell some premium. You can take advantage of that. I certainly like to do that as well, but you don't have to sit there and spend your whole day trying to get delta neutral and have all these different positions on for different contingencies, or you get into a play and it goes against you. So then instead of just taking it off and taking a stop, a lot of people will then put on like 3 new option strategies to help balance it out. And again, that's just making things too complicated. To make money in options, you got to keep it simple.
Yeah, and I think that is probably a universal recommendation for a lot of strategies, especially in trading. It seems that people see the world of opportunity out there and how many different things they can look at, and instead of just narrowing down on what they need to do on this specific trade, they put everything in, like you said, instead of just watching one option position, and if it starts to not go against them, trying to save that position instead of just moving into another position. And those are very effective words of advice, I think.
Well, trading is like effective trading is like an effective marriage. You got to keep things simple. Don't look at a bunch of other things. You just you focus on what you know best and go from there.
I think that's the wisest advice I've heard so far. Thank you.
Thanks for having me.
And thank you for watching the MoneyShow.com video network.
All right, the Money Show. So some of the takeaways out of there, they said this is a cheaper way to own a stock, right? Use the option, cheaper way to own the stock, and you got to keep it simple, right? Keep it simple and selling premium, right? We've heard that time and time again, sell premium. So real briefly, I'm going to show you guys a couple ways to sell premium real quick. And keep this show rolling. So I'm going to switch over. To Robinhood again. Go jump back into the hood. I'm going to just look at some simple ways that you can generate income selling premium. So first and foremost, we go into this account, right? It's purpose driven, right? Now everybody's made different amounts of money or whatever. I try to keep 40 to 50K in this account. And once I get to a certain point, I take money out and I buy real estate because I think that's a good hedge as well, not just options. But if you look here in the past year, this account has done over 180%, right? How did I do that? I didn't do it just flipping stocks. I did that off of trading options primarily. So if you look at the stocks here in this portfolio, it's 1, 2, 3, 4, 5, 6. There's only 6 stocks. This portfolio has 46K in it. It's only 6 stocks. So I see a lot of people who have accounts 2,000, 3,000, and they got 20, 30 stocks. And that's not how you make money. You don't make money by owning a bunch of stocks, like, 2 shares of Tesla, one share of Facebook, 17 shares of Bank of America, 13 shares of whatever, right? Whatever it is no rhyme or reason. And so I want to pull this account back up, and just so you can see it's purpose driven, right? It's purpose driven. Notice it's 100 shares of Square. It's 350 shares of Rocket. I gotta get 50 more shares of Rocket. I just didn't have enough liquid cash at the time, but it dropped yesterday. Look at it. It dropped 20% in the last week. So I thought it was on sale, because when it IPO'd a year ago, it came out at $18 a share, and now it's $18.08. So I'm like, wow, I can get it at the price it came out at. And now look at this bar; it shot all the way up to $41, and now it's down to 18. Okay, that seemed like some opportunity. So what did I do? I went here, and I'm only down 5% on the stock, but my average cost was $19.04. So why not get it for $1 less and accumulate? My goal is to have 500 shares in the next 90 days. And have here we go, and have 1,000 shares by the end of the year, because we got 1,000 shares. Every time it go up $1, I make $1,000. But if you only got 2 shares of the stock, every time it go up $1, you make $2. What's exciting about making $2? So this is what I did yesterday, May 7th. Yesterday, I bought 100 shares at $18.45. 100. I loaded up. And then I went back yesterday because I said, oh my goodness, it dropped all the way down to $18.03, and went and grabbed another 50 shares, right? It's called dollar cost averaging. So, because this is how you make money. Now that I have at least 300 shares, I can't do nothing with the 50, but I can go here and trade options, right? I can say, with today being May 8th, I can say, you got to June 4th. I'm going to sell a call, right? You got to June 4th. Now, right now, Rock is $18. So I'm gonna go a little bit out of the money. Let's go to $20, 50 cents, right? Basically, I could say I want 50 cents a contract, and I can sell 100. I can sell 3 contracts, right? Because I got 350 shares, right? And I hit review. Look at the bottom. It says you're agreeing to sell 300 shares of Rocket at $20 per share on or before June 4th. If you aren't asked to sell Rocket by then, you'll keep your collateral and the $150, right? But the reality is I'm gonna keep the $150 regardless. If they exercise or not, the $150 is mine. That's premium, right? We got a contract, and I'm saying yes. If Rocket hits 20 on or before June 4th, you can buy them off of me. But if you look at that, let me go back to that screen. I don't want to lose you. If you look at that, well, Rocket right now is $18.08. So if they go come back by June 4th and buy it off of me for $20, you see the contract says $20 strike price on the 6/4 expiration, then they're agreeing to pay me $20 per share. But I have 3 contracts, so that's 300 shares. That's $6,000. So they're going to pay me $150 right now to basically put my Rocket stock on layaway for them. They're going to give me $150 today, spendable cash money right now. And then by June 4th, if they decide to exercise, I'm obligated to sell it to them, all 300 shares. Now I only be having my 50 shares left, but I'm going to get another $6,000. So I'm going to get $150 today and $6,000 by the 4th. So that's $6,150 I would get if I execute that trade. Now, let's say Rocket is only $19 by June, $18.50. Let's say it go down to $17.50. If it's not $20, the contract is going to spiral worthless. And that means I keep the $150 anyway, and I still got the 350 shares, and I can go right back and do this again, right? I can hit them for $150 every month, and you hit them for $150 every month. $150 We can do the math. Do the math. It's simple math. $150 a month times 12 months is what? $1,800 a year. Right now, Rocket stock price is $18. I would have got if you do this strategy, you get 100 free shares of Rocket. If you want to look at it like that. If you just made $150 a month doing cover call off this company, right? But let's say I did have my 500 shares. That's 5 contracts. I'll make $250. If I have my 1,000 shares like I intend to, I could do 10 contracts. That's $500. $500 of free cash flow. That's like renting out a little bungalow. You might rent it for Section 8 for $750 or something, but after you pay the property taxes, homeowner's insurance, and maintenance, right? So it's leverage. But if I can hit you for 5 contracts and make $250 a month doing nothing, that's $3,000 extra dollars a year off 5 contracts. All right, so that's one way of doing it. Now look, we looked at the $20 strike price for June 4th. You could go out to June 25th. What did the 20 pay now? 82 cents. So I make $410 on 5 contracts or $246 on the 3. But I gave them to the end of June. You always want to be cautious on how much time you give them if you're selling options for income. So the reality of it is, yeah, you get $246 for the $20 strike if you give them to June 25th. But do I really want to give them a whole extra 3 weeks? With 3 contracts, I'd rather take the $150 instead of the $250, and I gave them less time. Because I can always just throw this right back out there and give somebody else another 3 weeks. So you want to find that sweet spot. When I sell cover calls, I like to do it between 2 to 4 weeks. Is about as much. I like to look at it like rent. You know what I mean? I don't really want to get nobody much more than 30 days. It's like collecting rent. So I'm not having to deal with all that, the hassle. You know, that's one example. Now let's say Square. Now I staggered into Square. I put $21,428 in the Square, right? But now I got my 100 shares up. And I didn't plop it all down in one day, right? Let me go through the history real quick. If you look here, and I'll show you the history, look at it. I bought some 5 shares, right? You can see the screen is full of, I basically about 5 shares at a time. Hit them on different days, 223, bought some 224, bought some another 224, bought some at $198, right? I stagger in, bought some more 216, 5 shares at a time, right? I didn't just drop 20 grand in there. If you look, I started January 5th buying, and I catch it here and there and keep buying, right? And I got done March 29th. So it took me 2 months. Now I had the 20 grand cash in there, but I wasn't so cocky or arrogant. I think I just know the best day or price. And I made it in my mind I wasn't going to pay more than $225 for my position. And because I staggered into the position, I actually came in $10 below my average price. So $10 savings on 100 shares, I saved myself $1,000 up front by staggering into the position. So now that's up, what, 9%? That's $1,900 on the stock side, right? Now you go to trade in the options. The reason I bought Square because it pays high options premium. So let's say I give somebody the end of May, right? Square's 233 right now. Let's say we're gonna give you, go June 4th, like we just did. Let's use the same example, same expiration, like it's rent money. Right now it's 233, the Square is. So if I think, let's say I want to call a 250, I want them to reach a little bit. Maybe Square jump $30. So we just made 250 off of the go 265. Right? I got the 100 shares. So right now, somebody would pay me $272 right now, cash, for the right hit review. It says you're agreeing, right? I'm agreeing to take on the obligation to sell 100 shares of Square at $265 per share on or before June 4th. If I'm not asked to sell Square by then I'll keep all of my shares of Square and the full $272 up front. Now, if I get assigned though, they gotta pay me $26,500 on or before June 4th if they exercise. The average person don't have $26,000 sitting around. You know what I mean? They just don't. And so that's why they say 10% of the time is when people actually exercise. So it's like, for me, it's free money. It's free lunch, right? You're willing to pay me $272 right now to come back and buy square off me for $265 a share. But let's say they do buy for $265. I only paid $215. I paid less than $215. So the difference between $265 and $215 is $50 on 100 shares. I'll make $5,000 extra on the back end, right? Because I'll take $274 on the front end for you to owe me, and that's at the $265 strike, right? There's the front end when you sell, it's the back end. The back end is the strike price. The front end is this little premium. But if you can stick somebody for $272 every month, and so look at what I just did though. That's $272 I can make every month on Square, and I show you how you can make $150 a month on Rocket. Now we already up, we over $400 a month, right? This is like rent money. If you can pull down $500 a month off your stock portfolio, trading cover calls or cash cover puts. Now I've showed you the call side. Last thing I'm gonna show y'all to wrap it up is cash cover puts. Let's look at Sundial. It's a cheap penny stock, but let me show you how this will work. If I trade the options, instead of doing the calls, I think it's gonna go down. So we're gonna use June 4th, just because of the expiration cycle we've been looking at. Now it's not a ton of I'm just selling, call me sell put. Make sure you're doing the right thing. So I'm selling a put. A put means I'll buy it off of you for that price, right? That's what you're doing. If you sell a cash cover put, you're accepting a premium up front, and you telling the person you'll buy it off of them. Now this one don't really have no attractive stuff that I would really sell, but because it's a penny stock, let me go into a different company. Just going into Nicola's terrible self. Nicola, we think Nicola's gonna go down. NKLA, we're gonna go by June 4th. All right, here we go. So right now it's 1140. All right, it's 1140. So 950 is a put. So if I looked at this put, and let's say I had $950 cash in this account, then that means that I could collect $53 right now up front. And if Nicola falls from 1140 down to 950, I would be on the hook to cash that person out. What I love about cash covered puts is you make money off the money you have just sitting around in your account that's not really doing nothing, off your dry powder. So let's say you had a couple thousand sitting around in your account, 1,900 to be exact, because 950 times 2, right, is 19 times the 100. So $1,900. If you had $1,900 cash in there, you could sell a cash cover put. So what does this mean? Somebody will pay you $106 today for you to stay liquid for till June 4th. Because if Nicola falls down to 950, you got to buy it off of them and make them whole. That's what that means. You took $106 up front like an insurance policy, like you was Flo or somebody, and that's what you're saying, that you will buy it off of them. You're obligated to buy them off of them if stuff hits the fan and Nicola falls down to 950. Now, that's a way that you remember for the video, it's a cheaper way of owning the stock. It's 1140. I could own it for 950 between now and June if it falls some more, and somebody paid me $106 up front to do it. All right. What if we kept it at the 950, right? But we changed the expiration cycle. We went to May 21. Look at what the 950 pay now. It only paid $24 because it's not likely that Nicola's going to drop 2 whole points in the next 2 weeks, right? So people aren't going to pay for that type of protection because it's not likely. And if you go further out, let's say you go to July 16th and we look at that 950, it ain't even on here, right? Go to the 9. The further out, sometimes they take off certain strikes. We go June 25th, they still got the 950, and that would pay $85. But you gave someone more time on their insurance policy. You like, look, If it dropped to 950 between now and June 25th, I got you. Okay, we're gonna pay you some more money up front since you got me. And again, this example, if you had the 1900 liquid, you getting 170 up front now instead of the 106. But you gave them more time, and that means you got to keep that 1900 liquid until that time because you are under an obligation. All right, but that's how you can do it. It's a way of you can get paid up front to make somebody else take a haircut, right? We go back to our original expiration June 4th. Maybe we don't look at the 950 strike. Let's look at the 1050 on the put, right? It's $1 less. You saying if Nicola dropped by $1 between now and June 4th, I can get 170 off of my but you have to put up more than 1900 collateral though now, right? Because now that's 1050 strike. So you have to have 2100 liquid between now and June 4th. But if you keep that 2100 liquid for a month, somebody's willing to give you $170 on that right now. Off of 2100, you made 170. Let's look at the real ROI there. You made $170 off a $2,100 investment. That's an 8% return you made in 30 days. If you can make 8% return every 30 days, that's 97% in a year. You can almost double up with this strategy, right? It's possible mathematically. It's not beyond the scope of reality. So I wanted to show y'all a couple of strategies that I use to make consistent income, and that is cash covered puts as well as cover calls. Nicola's a stock that I did terrible on the stock, but I did great on the options. You see here, assignments mean I got cashed out, so somebody cashed me out at 1702. Dig that. Right now, Nicola's 1140. So I pulled my parachute back in March. I saw it tanking, right? But I got out at 17. So it's somebody right now looking crazy that bought it off of me for 17. Now it's $11, right? So you got to know what you're doing. But I hit them right there, 3,200. Hit them there for $90, 180, 104. When you see these little hits, 82, 94, those are me selling covered calls. 44, that money adds up. Look at, I got assigned at 1850 assignment back in January. I'm not holding the bag on no $10, $11. 25, 48, 56. Anytime you see a minus, it just means I bought more. If you see a minus, it don't mean I lost $1. It just means I bought more shares. Hit them over there for 360. Hit them for another 220, right? Covered calls. Hit them for another 60. Ooh, hit them for 658, right? So that's a lot of free shares, a lot of free money up there I'm hitting them for, right? And all these minuses, you clearly see it says limited buy, limited buy, limited buy, limited buy, because I'm buying. And then you get back to boom, hit them for 330. All right. So that's how I make money, right? Doing options, right? I more than doubled up this year, right? You see it's 181% out of this particular portfolio. And I've pulled at least 20, 30K out of here already to buy property. All right. So because I try not to keep no more than 50 in this account because people making me nervous talking about that Robinhood gonna lock you up and freeze you out. It ain't gonna freeze out more than 50K of my bread, that's for sure. But I gotta keep at least 25 in here to be doing, teach the classes and do day trading. So anyway, hopefully some of that helped you all. I'm going to switch my screen back over to my laptop. I know that we're close to time, we're pretty much at time. And what I want to do is make sure that I've covered all my bases. Let's see here. Back, you should have seen my screen now. So those couple income strategies. And just as the video alluded to, there's even more patterns. It's even more strategies, right? We didn't even get into straddles and strangles too much and all those different ways you can do things, but study them. Again, this is about exposure. Very grateful for the Pontiac Public Library, Devin Bree and Green doing her thing, bringing you guys all the programming that you need to have an edge. And always a pleasure to be partnered with Bullish Institute and bringing you this value. I want to do is wrap this thing up. Part 3, we made it through the thick of things, got through the 3rd session. And, if there are any questions or answers, we'll be taking them on the back end. You can send a reach out to the Pontiac Public Library, and I will be in contact with them and get any of your questions answered. With that being said, this concludes the 3-part stock options trading course. So I want to again thank the Pontiac Public Library. Not sure if I want to have any words to close.
Well, yes, we. I just want to thank you, Ken, for doing these at a greatly discounted rate for the library. We are happy to have financial series, and we do share them on our Facebook Live and our YouTube channel. If anyone has any questions, you can look up Mr. Harrell and his Bullish Institute. They teach other training programs on stocks and stock options and financial literacy. And what is the website again, Ken?
Go to bullishinstitute.com. Just like it's spelled at the top of the screen, Bullish Institute, or you can look up. We're all on Eventbrite. We've got a stock options 3-part series coming up Monday evening, 7 p.m. Eastern Standard Time. So if you want to tap into that, you can tap into that as well. Look for us on Eventbrite. We're on Facebook, YouTube, IG, Twitter. We're out here. Bullish Institute, Bullish Picks, or Ken Blanks Harrell. Just look us up.
Okay, well, we're really grateful that you did this series for the Pontiac Library, and I personally am learning. It's great information, and I look forward to reviewing it and hopefully getting better with my own investment portfolio. So it's great to see you today and to see this this presentation, and I just thank you again. We'll be in touch for future series.
Awesome. I'm excited. Thank you so much for having me. Always a pleasure.
You're welcome. All right, that's the end of our program today.